Hold on. You want to fix the mics? The questions will be held toward the end for all the panelists, okay? All right. Thank you very much. Our next speaker is Dr. Jihad Nader. He's the Vice President for Institutional Advancement and Development and Professor of Finance at the American University of Dubai. For 13 years, he was AUD's Provost and Chief Academic Officer. He was formerly founding Dean of the School of Business Administration, Dean of Executive Programs and Professional Services, and MBA Program Director of AUD. Would you like anything else? I can keep going. All right, is that good? All right, come on up. Thank you very much. Let's give him a round of applause. I'll give you a warning at 10 minutes.
Thank you very much. I will need help with the PowerPoints, however. Right? This should be working then. Well, it's a pleasure for me to be here. In fact, I'd like to thank the organizers and especially my friend Jihad Nader, who is my namesake, as it happens. This is a good opportunity, in fact, for someone like myself whose professional background is also in banking, but whose academic career has spanned many years, and I've been at many universities, in fact, Toronto, Wilfrid Laurier, Concordia as Associate Dean, and I was banking director of the Institute, the Banking Institute here in the UAE in my first 5 years in this country. And so, as an academic and professional, I, in fact, am fortunate to have seen the transformation that has taken place and is still evolving transformation over the past many years, and now I think it's accelerating, which is making it very difficult, in fact, for us as finance people, whether we are practicing professionals or academics, to come to grips with what is happening to the toolkit, the models, theories, algorithms, concepts and so on that have stayed or have remained unchanged for many, many years, for all of the 20th century and well into the 21st century. We seem to be continuing to, dispense the same body of knowledge, and especially when it comes to finance, training, educating finance students, and also in, let's say, in the practice of the profession, using the toolkit that we picked up through our education. Major questions now arise about the usefulness of that toolkit. So my focus will be, or my perspective will be different, having in fact having gone through a comprehensive survey of what is happening in the financial markets and the world of finance that we live in today. I'd like to focus on the challenges facing financial modeling in a world of disruptive change. I'll start by citing a very well-known saying or line that is inscribed on the wall of King Tut's tomb. I have seen yesterday, I know tomorrow. And we seem as finance people to have adopted this without specifically saying this is what we're doing in financial modeling, which is critical for financial decision making. You need models in finance. Finance is a highly analytical and quantitative field by its very nature. So we need to develop skills and competencies in modeling. You take an abstract relationship or process or phenomenon and you try to come up with quantitative representations of those phenomena. That is the kind of training or education that our students at universities go through, and then they leave, they graduate, and they go into the workforce equipped with these tools. My question is, how good are these tools in this world of disruptive change? Can we continue to perpetuate their adoption and use? Will they help? The main theme of this event, of this conference, in fact, is how to, I'm going to paraphrase it, how to make sound financial decisions that help an investor to build personal wealth, I believe. I paraphrased it. How? How do we do that? Do we just take a guess? Do we flip a coin? Do we use our imagination? Do we make random decisions? Finance supposedly answers these questions by saying, no, you can model. You can actually look at meaningful, logical relationships that are tested and true, and you can use them to make sound financial decisions, decisions that are rational and appropriate in the economic sense, rational. I'll just go through, in fact, I will not take too much time, and you'll see that the content of this presentation is somewhat quantitative or technical, but that's okay. You will see more, I believe, presentations that go back to the world of practice and so on. A basic model in finance that everyone who is educated in this field is the Gordon model, the dividend growth model. And what it says is if you want to determine or estimate a rate of return, an expected rate of return, that would tell you that a given asset, such as a stock, is worth investing in this case it applies to stocks, then you have a formula that simplifies, in fact, the representation of future cash flows, expected cash flows from a stock, and encapsulates everything in terms of a growth rate. And so it simplifies the world. And at its outset, when this model was developed, the world was different. There was stability. There was no such thing as digitalization. The world was still very much the industrial, and we were living in the industrial age. And so the assumptions of this model were not totally irrelevant or unrealistic. So what this is saying is that for an investment in equity, if the expected return is higher than what is determined, the K here on the left-hand side, if your actual expected return, you believe subjectively that you can generate a return higher than this K, then you should go ahead. Otherwise, you should not. The assumptions are that the growth rate in dividends is constant forever. And of course, we start seeing the unrealism and the sort of impracticality of applying such assumptions. Although for many, many years, and even now, this model is still being used. I've used it specifically in utility rate of return consultancy, in fact, in North America. And it's still being used. This is the mainstay of, let's say, how you advise a utility company such as DEWA here, or the Rochester Power Company, and so on, about whether there should be an increase in the electricity prices to the public. So you go before a commission, and they use this model. Look at the assumptions. The forecast of the growth rate in dividends is based on history. So you look at dividends that were actually paid by this stock, and you take some kind of an average, long-term average. Usually it's a geometric mean. It's a mathematical way of taking a long-term growth rate. And you say this growth rate is expected to continue indefinitely, and you plug it into this model, and you proceed. So the assumption is that technology is stable, that there is no technological or any other kinds of disruption. Obviously, living in a world of ongoing disruptions, we have every right to question such assumptions and such a model. One financial analyst's comment is as follows: the Gordon model has much in common with Gordon's gin and tonic. And I say this, and I feel, in fact, a little bit embarrassed because Gordon was one of my professors. He passed away. And in his lifetime, he contributed significantly to the field of finance. So now it's being made fun of, sort of. It's just like gin and tonic, easy to make, but leads to tears in the morning if you hit it too hard. So, see, I'm starting, in fact, to touch upon the demise or the falling down, the failure of financial models that we have been instilling into our students. And the challenge that I face as a, let's say, a senior administrator and an educator, a professor of finance, is really a difficult challenge. How to make this transformation between or from those models that are still the stuff of textbooks and students use them all the time to something that is more relevant and more appropriate for the day and age in which we live. The M&M model, Modigliani Miller, anyone here who studied finance, and I assume some of you, or maybe all, have seen models like this, and they ring a bell. Nobel Prize winning authors all passed away. And it also states, or provides an equilibrium relationship whereby the expected return on a stock, this K sub L, if a stock is that of a company that uses debt, which all companies do, then you have a formula that is based on a long derivation that tells you the minimum expected rate of return if you want to invest in a stock. You calculate that rate of return, and then you use your subjective assessment. Is this stock likely to achieve for me a rate of return higher than this K? In that case, I'll go ahead and buy it. So again, we have assumptions underlying this model. One assumption is that the company's debt to equity ratio is constant. The company always uses the same mix of debt and equity. That may have been a not inaccurate statement in the middle, let's say, or the early second half of the 20th century. How true is this now? The company remains in the same business risk class. So the company keeps on basically cloning itself, reproducing itself, never does anything to diversify its business, go into different technologies. Once again, it implies that there is no technological or other disruptions that affect the operating risk or financing risk. These are ruled out.
5 more minutes.
Yeah. So we use what was yesterday to forecast what will be tomorrow. And we still teach that. We still tell students that you use the appropriate model that you believe is applicable to your case, and you will be making sound financial decisions that will help you generate wealth. Look at also the well-known mean variance models, Markowitz and the capital asset pricing model. Once again, we have a relationship between risk as measured by beta, that's volatility or systematic risk, and the expected return on the asset on the left-hand side. It's all based on a notion of some market portfolio or a market index, such as the S&P 500. It depends on here it would be the Dubai Financial Market Index. Again, the assumptions are that beta, the measure of volatility, is stationary. It never changes. And that we use, and this is standard methodology, we use at least 5 years of monthly historical data to estimate the beta, the volatility of a stock or of any risky asset today. Once again, we are using the past to predict the future. And it's not like the recent past. It could, in fact, go back many years. For example, you could be looking at an asset and you have data going back 10 years. And then you use a moving average to estimate beta today and say this volatility, the extent to which this stock fluctuates with the market, will continue. And that's based on an assumption. Whereas in a world full of disruptions, we know that the volatility is not stable. It's not steady. Doesn't stay the same. I will not go into details of this model. This is a generalization of the previous one that takes us to more than one driver of the expected return. It goes beyond the market portfolio to apply any number of what is called systematic factors, risk factors. Again, the same assumptions and implications apply. We use history to estimate relevant risks and to forecast commensurate expected returns. So what are we looking at, in fact? In the early finance literature, there used to be a distinction made between risk and uncertainty. Risk was supposed to be a state of affairs in which you are able to assign a probability to different possible outcomes. So you can assign a probability, and it's usually based on past information or past data. Uncertainty, according to that economist Frank Knight, was a situation in which you were not even able to assign probabilities. You don't know how to assign probabilities, so that was uncertainty. Gradually, that distinction disappeared, and you will not find it now. But I think it's time now to return to that distinction, because we now live in a world of uncertainty. We cannot and should not use historical rate of return or price data to assess risk, because it's always changing. We're dealing with uncertainty, and we don't know how to deal with uncertainty. And that's the challenge, the main challenge. So Again, historically based probabilities are becoming increasingly useless, but we still teach those methodologies. I'm speaking as an academic, challenging the academic institutions that continue to perpetuate this, and we are at a loss. I have to say, there's not much research now taking place to try and do away with these models and find something that works today and tomorrow. All right, so basically, we go back to simplicity. That is what some are suggesting. Chuck, get rid of all of this and go back to teaching soft skills. Let artificial intelligence, let the technologies of today that can analyze and churn data and, for example, business analytics and all of that, let those algorithms take care of the analysis and focus on building skills in judgment, in communication, and soft skills that make individuals capable of, once they have the outcomes of the artificial intelligence analysis, capable of making selected or judgmentally sound decisions on investments. If this trend continues, it's likely that the most valuable skills will be non-technical ones: understanding the business, building relationships and trust, communicating analytical outcomes, how to communicate, and working in teams to convert analytics into action. These are the very skills that business schools tend to value very highly, and also in the business world, these are the skills that people look for. And so I claim that the age of quantitative, highly mathematical finance and passing this on to students and trying to use these models is coming to an end. What we're looking at in the future is an ability to analyze the now and the future. And we need to build those skills and relegate the computational and mathematical part to artificial intelligence. How to do that is a challenge to be addressed. I conclude by going back to that saying I have seen yesterday, but I don't know tomorrow. Don't use yesterday to predict tomorrow, with apologies to King Tut.
Thank you very much. Thank you very much. All right. Okay. Our next speaker is Dr. Jamil Halik. He is the head of investments at Riyadh Bank. He is a senior debt expert with a proven track record in global markets and emerging markets, and also fundamental credit analysis focused on high yield and corporates, and quantitative analysis focused on relative value and credit models attached to fundamentals. Also, he has been a credit derivatives trader since 2001, so he brings a great deal of experience there as well. Mr. Jamil, please come on up. Doctor or Mr.? I'll let you know in 5 minutes.
Yeah, thank you. Good evening, everybody. So, unlike everybody, I'm not an academic. I have, I'm on a daily basis in markets investing. I've crossed paths with Dr. Azam and Marios, who are much better speakers than myself. But I think the basic idea today is I wanted to bring to your attention what could be, let's say, a sort of indicator that you should follow when it comes to investment. When you invest, you have to look at the risk and the rewards. And therefore, I wanted to bring an observation, nothing more than an observation of the state of the world today. And I called today, in the meeting today, I said, okay, we probably going to live in a decade of perpetual debt. Why I'm saying this, and this is what I'm trying to, I will try to prove to you, and you will have a lot of time to ask me about a question about it. So there is an American proverb that says, if you owe a bank $100,000, the bank owns you. But if you own the bank, you owe a bank $100 million, you probably own the bank. And that's the reality of today. So the history of debt. So debt has existed as long as money existed. It has been used initially to back up economies, to help go out of recession, save the world, World War II, civil wars. That's the historic of how debt has been used. So initially it has a positive effect, but too much of debt has the opposite consequences, and probably we are starting to see some consequences. You know what's happening in France, or what happened a couple of years ago, maybe in Greece. Sorry, Marius, but I think it's something to look. Whenever you invest, you are bound by the direction of global markets, and today there is too much debt in the system. And you are bound as well by the leverage of the entity where you are investing. So why debt has been growing so much? Initially, it started with the Keynesian model. And the Keynesian model, it gives effectively the power for governments to spend using debt. And what is it effectively? So the model of Keynesian is like a family. It's like a father who gives money to his own children to invest. And basically he would say that it stays within the family. And he never asks that much about repayment, maybe at some point. So that's the relationship that the government have with citizens. So governments, they increase debt, and then later on, the citizen has to pay it. So I'm saying this because if you look at the level of United States today, on an absolute basis, they're reaching 100% of GDP, and on a relative basis compared to the rest of the world, they are probably the most indebted on a notional value. That's too much debt in the system. The other part as well is low interest rates. So since 2008, what happened is we added 100 trillion of debt. So we went from 150 trillion, and now in 2019 we're probably at 250 trillion. Of course, parallel to that, growth has happened. The world has created wealth, has created growth, has created market cap. But if we look at if we aggregate the world today as one capital structure, on one side you have liabilities, and the other side you have assets, the liabilities being the debt, which is 250 trillion, the other side being the assets we're taking as growth. Growth today worldwide is probably 80 trillion. Market cap, if you look at the MSCI Global, is 40 trillion. That's effectively not enough to back up the amount of debt in front of it. So you need two conditions, if I go back to the financial models, is first of all, you need to have growth that is equal or superior to the interest rates that is attached to that amount of debt. And secondly, you need to continue to create debt. That's why I'm saying there is a chance, and I'm not calling being a catastrophe, but there is a chance where we're probably living in a perpetual debt environment. Because how can the difference between an obligation and a debt or an equity is at some point there is a maturity and you need to pay it back. So how would you pay it? And that's the real question. And there is the only way of repayment, the easiest way of repayment, is effectively rolling over this debt at maturity. And probably, I would say, although the world is healthier, companies are generating more revenues, balance sheets are cleaner, but the system has too much debt. There are certain banks behind, but this debt needs to be repaid. And we probably, in order to have a stable, let's say, system in financial markets, we need to find ways to stop increasing debt and create more value. That's why I'm saying there is a big chance that we are in a perpetual mode of debt. And if you look at, for example, the United States, or you look at Japan, they are leveraged up to 230%. their interest rates, it goes back, they are probably at zero. Now the US Federal Reserves, they are going back a little bit from their policy of tightening of monetary policy, because you know what, if they increase debt, if you increase interest rate, they increase their cost of funding as well. So, you know, that's why I'm as I said earlier, I'm optimistic with being a little bit careful here and there. And, you know, the consequences of repayment of debt, it goes back to the taxpayer, it goes back to many other layers into the economy that could translate, if there are too much, on populism action that we're starting to see, and we have seen in some countries. So I don't want to go, I don't want to say too much about it, but that's the basic idea I wanted to see. I wanted to tell you that we're probably in a better world since 2008, but I think the matrix of, let's say, the capital structure of the world has changed, and probably with a little bit too much of debt around us. That's it for me.
All the speakers up there? Questions?